The S&P 500 is like a report card for America's top 500 companies, tracking their collective performance and giving investors a snapshot of the market's health. When it moves, so does your money. Whether you're a seasoned investor or just starting out, its swings can impact retirement accounts, college funds, and more. Last week, the market was a roller coaster. There was a sharp drop on Friday after tough White House talk on China, sending shockwaves through trading floors and rattling investor confidence. Then a rebound came on Monday as both sides hinted at negotiations, offering a glimmer of hope and sparking a quick recovery in stock prices. This whiplash is a sign of growing volatility after a long, calm stretch, almost 100 days without a 5% dip, which lulled many into a sense of security. September and October are historically stormy for stocks, with past crashes and corrections often clustered in these months, making investors extra cautious. Experts warn the calm may be ending, and that the market's mood can shift quickly as new headlines break. For investors, this means the easy gains could pause, and portfolios may need a closer look to weather the turbulence ahead. The market is reacting sharply to every headline, with even small pieces of news causing big swings in prices and sentiment. As of Tuesday, the market was down again, showing just how bumpy the ride is getting, and reminding everyone that uncertainty is the new normal. The big question, was last week's plunge just a blip, or the start of something bigger? Investors everywhere are watching closely for clues. Most experts say it's a tremor, not an earthquake. But they're urging caution, reminding everyone that markets can turn quickly. The market's fragility is clear, and it's time to buckle up for what could be a volatile season ahead. Stay alert, the next move could be sudden, and being prepared is more important than ever. Let's decode the jargon. When you hear the term pullback, it means the market has dropped by about 5–10%. Think of it as the market taking a quick breather after a strong run, not a sign of disaster or collapse. Pullbacks are a normal part of the market's rhythm, and they often give investors a chance to reassess and regroup. A correction is more serious, a 10–20% fall that can signal deeper problems and spark real investor anxiety. Corrections can feel unsettling, but they're also a natural part of long-term investing, often helping to reset overvalued markets. Pullbacks are common and healthy, acting as a pressure release valve for the market. Corrections, while rarer, are more stressful and can test investors' nerves. If the drop hits 20% or more, that's when we enter bear market territory, the real trouble zone where pessimism can take over and losses can deepen. Volatility is the market's mood swings, and lately, those swings have been getting wilder. The VIX, often called the fear gauge, measures this volatility and has been spiking recently. High volatility means uncertainty is in the air, making investors nervous and sometimes leading to rash decisions. Right now the big debate is whether we're just seeing a minor pullback or if a bigger correction is on the horizon. Experts are weighing in, but no one can predict with certainty. Understanding these terms helps you keep perspective, avoid panic, and make smarter decisions when markets get rocky. The market's smooth ride is turning bumpy, so it's important to know the difference between a temporary pothole and a dangerous cliff. Stay informed, stay calm, and don't let fear drive your decisions. Knowledge is your best defense in uncertain times. Why the worry? What's making so many experts uneasy about the current state of the market? First, stock prices are high. After a 36% rally, many look expensive compared to company profits. Valuations are stretched, and some analysts say the market is pricing in a lot of optimism about future growth. That makes the market fragile, like an overinflated balloon. Even a small pinprick of bad news could cause a sharp reaction. The biggest concern, the US-China trade dispute. Tensions between the world's two largest economies create a cloud of uncertainty over global business. Every new threat or truce sends stocks swinging. Markets are reacting to headlines, not fundamentals, making them unpredictable. Uncertainty is toxic for business planning and investor confidence. Companies hesitate to invest, and investors get nervous. Add in recent government shutdown drama, and the market is hypersensitive to political news. Policy changes and political gridlock only add to the anxiety. Experts warn that investor optimism is dangerously high, with many crowding into the same tech stocks and using borrowed money. This herd mentality can amplify risks. If a sell-off starts, it could quickly snowball as everyone rushes for the exits. The speed of today's markets means losses can pile up fast. Elevated sentiment and crowded trades mean a small shock could trigger a big drop. The risk of a sudden correction is real. The market's on edge, and even minor bad news could have outsized effects. Investors are watching every development closely. Stay cautious. This is a time for vigilance, not complacency. With so many warning signs flashing, it pays to be prepared for sudden changes. Wall Street's top strategists are waving caution flags. Morgan Stanley's Michael Wilson warns the S&P 500 could drop 13% if trade tensions persist, but sees it as a long-term buying opportunity. JP Morgan's Andrew Tyler urges caution too, citing high valuations and crowded trades. He says, a trade truce is needed to calm nerves. Both agree, don't get swept up by rallies, and be ready for choppy markets. Evercore ISI's Julian Emanuel expects more selling, especially if trade disputes escalate or big investors start reducing risk. All see a pullback as a healthy reset, not a disaster. The message, brace for turbulence but prepare to buy quality stocks if prices drop. Stay patient and keep your strategy clear. So, what should investors do? Don't panic, be prepared. Volatility brings risk, but also opportunity. Pullbacks let you buy great companies at a discount. Have a plan and some cash ready. A drop could be a chance, not a crisis. Technical analysts see a 5% pullback as healthy, setting up for future gains. Pay close attention to news on trade talks and policy. These will drive the next moves. Stay informed, avoid emotional decisions, and review your risk. For long-term investors, short-term swings are just noise. Buckle up, stay steady, and look for opportunities amid the bumps.